The Reserve Bank has made it very clear, really, since this easing cycle has begun, that it needs a reason to cut interest rates and equally a reason to hold interest rates, but it does need a reason to cut, and those reasons are a bit thin on the ground at the moment. And part of the reason is that the labour market, I mean, we want people in jobs, of course, but the labour market is too tight, and inflation is not quite where the bank wants it to be. The bank wants it to be in the middle of the inflation target of between 2 and 3%, and at the moment that core number, that underlying figure, is just slightly above it. And the recent headline figure we got on that monthly CPI data was actually at 3%. So the Reserve Bank wants confidence that underlying inflation, that's that inflation that really smooths out all the bumps in the data, is coming down and is going to settle around that 2.5% target. And the evidence is pointing to the fact that we're very, very close to that, but not quite there yet. The bank will be looking for their next big quarterly CPI data to give them that confidence, Ros.
And that comes before the next rate decision.
That's right. And in fact, the odds are that there will be a Melbourne cut rate cut.
David, I'm going to stop you there for just 1 second to bring everybody the breaking news that the Reserve Bank has left interest rates on hold, as expected, at 3.6%. Following its latest board meeting in what is a widely expected decision. Well, I'm pleased to say that in the studio with me is Chief Economist at Ray White, Nerida Conisbee. Nerida, so no surprises?
No surprises. As David said, it was only about a 4% chance of a cut today, so as expected.
So what does this mean for the rest of the year then? We heard David saying that we're going to wait for that quarterly inflation number that comes out before the next rates meeting. Does this on-hold decision mean that it's more likely that we'll get a cut in November?
Look, it does depend a lot on the data that comes through this month, or next month in October. So specifically the unemployment data, we did lose 5,500 jobs in August. If that continues to deteriorate, it could mean an increased chance of a cut. Also the inflation rate, the true mean inflation for August came in at 2.6%. So if it does come down a little bit more, it could also lead to a cut. Markets are pricing in one more cut now instead of two. So that's the case for the market, but we do know that they can change very, very quickly depending on the data that comes through.
And it was the most recent inflation number that meant that the markets changed their forecast to 1 rather than 2.
Yeah, so with the unemployment data coming through, the markets were pricing in about a 10% chance of a cut. Then that inflation number came through and it sort of wiped out any chance. So yeah, it does change very, very rapidly depending on what data's coming through.
What are the main inflationary pressures out there right now?
There are a few. Construction costs are still problematic. Rents have settled down, but the big part of that 3% headline inflation was the ending of the electricity rebate. So they're no longer holding out, and so as a result, inflation increased. So it will be an interesting month. I think the quarterly numbers will be interesting to see what the impacts are of all the various changes.
Consumer spending is also picking up, isn't it?
Yeah. It's a very mixed market. So we do know consumer sentiment is pretty low at the moment. The interest rate cuts have helped this year. There's been 3 cuts coming through. We've got a lot of variable data. I mean, if you have a look at fuel prices, for example, they have come back quite significantly. That's obviously helping households, but then insurance costs are increasing across the board. So that's creating a lot of problems for a lot of people. So a lot of mixed data, bit of job loss, the electricity rebates coming to an end. All of those things are making it very hard to predict at this point.
I'll throw another one in there. That's the government's upcoming housing boost. This is the first home guarantee. Is that going to push up house prices and be inflation?
Yeah, look, it already is. So that 5% deposit scheme does come in tomorrow, and it does apply to people on all income levels, obviously first home buyers, but we can definitely see it at the cheaper end of the market, the more affordable end of the market. We are seeing much more accelerated price growth than the rest of the market. So it is creating a lot of pressure on affordability. It's meant to help with affordability, but it is creating pressure primarily because we're not building enough homes at this point.
You mentioned the tight labour market. Is it a surprise that the labour market has been so resilient?
It has been a surprise. I mean, the fact that we did see a bit of a softening in August was a little bit concerning. Unemployment is still sitting at 4.2%, so not alarming at this point, but if we do continue to see a rise in unemployment, it will lead to greater pressure on the Reserve Bank to move in November.
Nerida for now, thank you. Let's go back to David Taylor, who's down at the Reserve Bank. David, you've been looking at that all-important statement from the RBA. What stands out for you?
Ros, sometimes nothing stands out and I've got to try and work around it. Right now, though, I'm looking at one phrase that's made my stomach drop in terms of the outlook for inflation and certainly the outlook for interest rates. The heading is, within the statement, a subheading is maintaining price stability and full employment is a priority. But the first sentence starts with the fact that with signs that private demand is recovering, indications that inflation may be persistent in some areas. May be persistent is the phrase that caught my eye, and this is what it all goes back to. The fact that the Reserve Bank has a mandate to achieve price stability. It's not to whack inflation down to nothing. Everybody knows that. It's to achieve price stability. The inflation figure that the Reserve Bank has to achieve that, along with sort of sustainable economic growth, make sure everyone who wants a job can have one, make sure when you don't go to the shops that you're slugged with big bills, basically making sure there's the welfare of Australians is maintained. The key number, as far as the Reserve Bank is concerned, is 2.5% annually. So we're a little bit above that. And what the Reserve Bank is saying in this statement is the jobs market's pretty tight, so around about 4.1, 4.2, 4.3%, depending on which month you check the unemployment rate. The problem with that is that you've got a lot of people in work and a lot of people able to spend. So when the government just eases off a little bit in terms of its spending, because it's got a big deficit and a big budget, big debt, the Reserve Bank has eased monetary policy so that the consumer can come in to pick up the growth pattern for the economy. And what the Reserve Bank is saying in this statement is the consumers come in just a little bit too hard and fast, and that's consistent with the idea that there are lots of people in work. But Ros, the kicker here is that productivity is still too low. So you have gangbuster productivity, per unit labour costs come down, and a boss can throw out a pay rise without it affecting how much he has or she has to flow on to her customers in terms of price hikes. So at the moment, the Reserve Bank is scratching its head thinking, OK, we've done what we can in terms of lowering interest rates to this point, but productivity is too low to make sure that inflation comes down even further. That's the problem, and it's because demand is kicking up a little bit. So inflation's proving a little bit too persistent at this point.
OK, so you're there in the room at the Reserve Bank where the Governor, Michelle Bullock, will face the media shortly. What question will you be asking her?
Sometimes the questions come the moment before I'm about to ask a question, because someone's already asked the question I want to ask. But no, look, I think there's a couple of things. Business editor Michael Yander suggested to me before I came here that I ask her how she's going in the job so far. And she's been in the job for quite a while, but it would be nice to get a light moment from Michelle Bullock just to find out her demeanour, because there was this narrow path that the Reserve Bank was walking along, trying to ease the cost of living for Australians via interest rates, but also not trying to fuel inflation again, but not having interest rates up too high to push the economy into recession. She said she wanted to retire that phrase, about 3 meetings ago, and now she would be very frustrated that there's just a little bit of persistency in the data to suggest that the war on inflation is not yet won. So maybe the question to her is something like, just how frustrated are you that inflation is not getting in the middle of the right smack bang in the middle of that target band like you'd hoped? And is there more emphasis on the government now? Because you've done as much as you can, but productivity is still too low. And when productivity is low, it's hard for workers to get those big pay rises that they deserve without putting upwards pressure on inflation. And Ros, then the attention focuses back on the Albanese government to do what it can, which it has done in terms of the productivity forum, but we're still lacking the hard evidence to show that productivity is in fact improving.
David, thank you so much. Let's go back to our economist, Nerida Conisbee, with me in the studio. So we've got that statement now. Today's policy decision was unanimous, we were told. Did your heart drop when you read what the statement had to say about inflation?
It wasn't surprising. I mean, one of the things that they did highlight was the uncertainty in the global economy, and we have seen in the US now inflation is re-emerging. Tariffs obviously are creating quite a lot of problems in that economy. The UK is continuing to see inflation reigniting. hiding that's quite problematic. So it is consistent now what we are seeing around the world that, it was hoped that inflation was under control, but there's still a lot of problems in the economy which are leading to it not coming down as quickly as anyone hoped.
So what's your forecast then, just to go back to that for the rest of the year?
Yeah, look, I think there will be a cut in November at this point. I think it will obviously will depend on what happens with that labour market data coming in a couple of weeks, also the quarterly inflation data, but certainly not 2 cuts as hoped by February. I think it's 1 cut, ideally November, but otherwise probably February at this point.
Is the government doing enough of the heavy lifting David alluded to?
Yeah, the productivity one is a hard one. I mean, we did have the economic roundtable which looked to address it. I don't think a lot came out of it, particularly with regards to the construction sector, but obviously it is a focus, it's been acknowledged, and there needs to be more done.
Nerida Conisbee, very good to get your thoughts. Thank you so much for coming in.
Thanks for having me.
That's where we'll leave our rates coverage for now. We're bringing you the Treasurer, Jim Chalmers, speaking about today's rates decision, no move.
3.6%. This is not the outcome that millions of Australian homeowners would have wanted, but it's certainly the outcome that markets and economists were expecting. Interest rates have already come down 3 times in 6 months this year, and that's a very good thing. The 3 interest rate cuts which are already in the system are already providing very welcome relief to millions of Australians with a mortgage. For a household with a mortgage of $700,000, the rate cuts this year means they are saving about $330 a month, or about $4,000 a year. Now, the progress that we've made together on inflation this year has already given the Reserve Bank the confidence to cut interest rates 3 times in that 6-month period. Now, we know that when interest rates are cut around the world, they're not always cut at every meeting, or indeed every couple of meetings. And so this outcome today from the Independent Reserve Bank is not a surprise to markets.
And this is where viewers on ABC TV are leaving us. You can keep watching on the ABC News channel. Bye for now.
Would have been hoping for. If you look at the progress that we've made on inflation, on the most reliable measure, we've got both headline and underlying inflation at their lowest rates in almost 4 years, and both of them back in the Reserve Bank's target band. Now, whether it's the more volatile monthly measure or even the quarterly measure, we do expect inflation to bounce around, but we have seen it at lows for the last 3 or 4 years when it comes to those quarterly measures, and that does reflect the progress that we've made on inflation. The Reserve Bank statement also goes into the global economic uncertainty that we are confronting here in this country and indeed around the world. And what that global uncertainty means is that the Reserve Bank has taken this decision to stay pat for the time being in the face of that uncertainty to see how it pans out. We have identified as a government, as the Reserve Bank has as an independent monetary policy board, that volatility and uncertainty in the global economy does weigh heavily on our own domestic economy and on the decisions that we take as a government and as an independent Reserve Bank board. In the face of all of this uncertainty, Australians should be proud of the progress we've made on the economy. We've been able to get inflation down while maintaining low unemployment. We've seen real wages and living standards grow in recent data. We've also been able to get the debt down substantially, deliver a couple of surpluses and a much smaller deficit, as revealed in yesterday's final budget outcome. And the Reserve Bank has also pointed out in its statement today that one of the really encouraging elements of our economy in recent months is we are seeing the private sector pick up its rightful role as the primary driver of growth in our economy. We've been able to keep the economy ticking over. We've been able to keep unemployment low. We've made very substantial progress on inflation. We've made welcome progress as well on real wages and in the budget as well. But we know that there's more work to do in our budget and in our economy, and that's the government's focus. Now, I'm conscious that the Reserve Bank Governor is up shortly, and so I'll take a couple of questions but be briefer than usual. Over to you.
Prior to today's decision, economists have revised their rate cut prediction after the latest monthly inflation figures. Did today's announcement confirm that inflation is driving a flat line in rates?
Well, a couple of things about that. I mean, first of all, I don't make predictions or preempt decisions taken independently by the Reserve Bank. There are good reasons why treasurers of both political persuasions don't do that. The market expectations change from time to time, but even before that most recent monthly inflation data, there wasn't a real expectation of a rate cut today. Obviously, after decisions like this, and people will tune into the Governor at 3:30 this afternoon, the decisions taken by the Independent Reserve Bank, the statements they release, the press conference that the Governor does, all of that has implications for people's expectations of interest rates into the future. My job is to focus on my part of this, which is to get the budget in better nick, and we have, to get inflation down, and we've played a helpful role in that. Keep the economy ticking over, grow real wages, and on all of those fronts, we've got more work to do, but we've made good progress.
Are you concerned that the RBA won't cut interest rates anymore this year?
Well, again, I don't engage in that kind of commentary. We've seen interest rates cut 3 times already this year. When we came to office, interest rates were already rising. Inflation was around double what it is now and rising fast. We've been able to get inflation down. We've seen interest rates cut multiple times as a consequence. We've got real wages growing, we've kept unemployment low, we've got the budget in better nick. So all of that represents good progress, but we know that there is more work to do. People are still under pressure. They're getting some welcome relief from those 3 rate cuts earlier this year. They're getting relief from the government in the form of tax cuts and responsible cost of living help, but we know that there's almost always more work to do.
Treasurer, can I just ask your thoughts on another matter? Just on the Seven West and Southern Cross proposed merger. What are your thoughts on it? Do you support it? Do you have any concerns at this stage?
Well, obviously, I'm across the announcements made by the potential merger partners, and we monitor these kinds of developments closely. I get briefed from time to time on these kinds of proposals. But we need to recognise that the ACCC will go through a process, as will ACMA, the relevant communications authority. They will both review this proposed merger in their usual considered way, and it's important that I don't preempt decisions taken by those independent regulators. As I understand it, the deal would also still require shareholder approval. And so it's been announced. Obviously, we've clocked that. Obviously, we will get briefed on that from time to time, but primarily there's a role here for 2 of our regulators, our competition regulator and our media regulator. There's an important role for shareholders as well, and there are good reasons why I won't preempt any of those processes.
Also on a slightly different matter, why are the housing improvement rates falling further behind? Is the housing target unrealistic?
Our housing target is ambitious, but it's achievable. And in the last little while, we have seen some welcome progress when it comes to the housing market. And even if you look at those numbers which were released today on approvals, it's important to remember that even though building approvals fell in August, they are still up 3% in through-the-year terms. So in through-the-year terms, we've seen a 3% growth when it comes to approvals. Now, when we came to office a few years ago, the construction sector was facing very challenging conditions, partly because interest rates were already rising, construction costs were rising sharply, dwelling investment was going backwards, and approvals were in freefall. And we've been able to turn those things around, but we never had the expectation that we would turn them around overnight. It's happened over a period of time. So if you look at the trend series for monthly building approvals, which takes out some of the volatility, building approvals are growing at 5.8% now. They were going backwards by 21.7% when we came to office. If you look at cost growth in construction, it grew 0.7% through the year. Most recently, it was growing at 19.4% when we came to office. If you look at dwelling commencements in the March quarter, it was up 17.3% in annual terms. It was falling 28.5% when we came to office. Dwelling investment growing at 4.8% now. It was going backwards 5.1% when we came to office. Investment in new builds rose 4.8%. In annual terms, in the most recent data, it was falling 8.4% when we came to office. So across all of those indicators, when you take out the month-to-month volatility and you look at the trends over the last 3 years, we have actually made some really good progress in the housing market, but it remains the case that our target is ambitious. We know that. Everybody needs to do their bit. The Commonwealth is certainly doing our bit.
So one of the challenges that you faced with that target earlier was interest rates. Now that they are starting to slow down, do you anticipate that creating further challenges with that target?
Well, we've seen 3 interest rate cuts this year, and that will obviously have an impact on building and construction. The most recent movements in interest rates, the 3 most recent movements in interest rates have all been down, and that has been helpful when it comes to construction costs and new building. But it's not the only reason why we've seen that 3-year improvement across all of those, all of that data that I mentioned a moment ago. You know, our predecessors did almost nothing on housing, and as a consequence, we started way back. We've been able to turn around things like construction costs and approvals and new investment. All of that is welcome, but we know that we've still got 4 years to go in this target. It's an ambitious target, but it's achievable. Today's monthly data is notoriously volatile. The through-the-year data paints a much more encouraging picture. Thanks very much, everyone.